Two people, same company, same day. One walks away with 10 times more money. The other, broke. And the difference between them wasn't luck. It was a choice. The choice between stocks and options. Today, I'm going to break down exactly what each one is, how they actually work, why options can make you rich or destroy you overnight, and which one might be right for you. Stay until the end because the mistake most beginners make with options is the single fastest way to lose your life savings. Let's start with the basics. A stock is the simplest investment in the world. When you buy a stock, you're buying a small piece of a real company, a tiny slice of Apple, Tesla, Amazon, whatever you choose. If that company grows, your piece grows with it. It's like planting a tree. You put something in the ground, you water it, you wait, and over years, it becomes something valuable. For example, if you buy one share of a company at $100 and that stock goes up to $120, you've made $20. Simple, clean, predictable. That's how most people build wealth over decades. It's slow, it's boring, but it works. And Warren Buffett, one of the richest humans alive, built his entire fortune on exactly this principle. But here's where it gets interesting. Stocks are predictable. Options are dangerous. An option isn't a piece of a company, it's a contract. It gives you the right to buy a stock at a specific price before a specific date. You're not owning the house, you're buying the option to buy the house later at today's price. And that changes everything. Let me give you a concrete example. Say Apple stock is trading at $170. You think it's going to jump after earnings next week. Instead of buying the stock, you buy a call option. A call option gives you the right to buy Apple at, say, $180, and it expires in 2 weeks. You pay a premium for that right, maybe $5 per share. So for $500, you control 100 shares worth $17,000 of Apple stock. Now imagine Apple earnings crush expectations. The stock jumps from 170 to 200 overnight. Your option? It doesn't just go up proportionally, it explodes. That $5 premium might now be worth $25 per share. You just turned $500 into $2,500, a 400% return in 1 week. That's the power of leverage. But here's the part nobody wants to hear. That same leverage can destroy you because options expire. If Apple had dropped to 160 instead of rising, your option would have been completely worthless. Not down 5%, not down 20%, gone. Zero, every single dollar. That $500 premium completely wiped out, and there's nothing you can do about it. This is what most people don't understand. Stocks lose slowly. They give you time to think, to adjust, to recover. Options lose fast. They have expiration dates. They have something called time decay. Every single day your option gets closer to expiring, it loses value. Even if the stock doesn't move, the clock is always ticking, and that clock is not your friend. Think of it this way. A stock is like owning a house. It might go up or down in value, but it doesn't disappear. An option is like renting a house with a lease that expires. When the lease is up, you're out, no matter what. That's why experienced traders say options are a decaying asset. Every second you hold one, it's worth slightly less than the second before. So why does anyone trade options at all? Because smart traders don't just buy options in hope. They use options strategically. They use them to protect their existing stock positions. They use them to generate income from stocks they already own. And they use them to make calculated bets where the math is in their favor. The difference between a gambler and a trader isn't the game, it's the strategy. For example, if you own 100 shares of Tesla and you're worried about a short-term drop, you can buy a put option. A put option gives you the right to sell your shares at a specific price. If Tesla crashes, your put option gains value and offsets your losses. It's like insurance. You're paying a small premium to protect a large position. That's called hedging, and that's how institutions manage billions of dollars. Another strategy is called covered calls. If you own stocks that aren't moving much, you can sell call options on those stocks and collect the premium. It's like being the insurance company instead of the customer. You get paid every month whether the stock moves or not. It won't make you rich overnight, but it creates steady income from stocks you were just sitting on anyway. But here's the truth most finance channels won't tell you. 90% of options traders lose money. That's not an opinion, that's data. The average retail options trader underperforms the market by a significant margin. Why? Because options are emotional. They move fast, they create greed and fear in amplified doses. And most people are terrible at managing those emotions. The psychology is brutal. When you're up on an option, greed tells you to hold longer. When you're down, fear tells you to hold and pray. Both emotions destroy traders. The best option traders are the ones who can remove emotion entirely and follow strict rules. Cut losses early. Take profits on schedule. Never risk more than you can afford to lose. These aren't just tips, they're survival rules. So, which one should you choose? If you're a beginner, the answer is almost always stocks. Start there. Build a foundation. Learn how markets work. Understand companies. Build patience. Because patience is the one skill that makes you money in markets, and options will destroy you if you haven't built it yet. If you're experienced, if you've been investing for years, if you understand risk management, if you can lose money without losing your mind, then options can become a powerful tool in your arsenal. Not a replacement for stocks, a complement, a way to protect what you've built and accelerate what you're growing, but only if you respect the risk. Here's the framework I'd suggest. First, build a stock portfolio. Solid companies, ETFs, index funds. Let compounding do its work for 5 to 10 years. Second, learn options on paper. Practice without real money. Third, when you're ready, start small, one contract at a time. Never risk more than 5% of your portfolio on any single options trade. And always have an exit plan before you enter. The difference between stocks and options isn't just technical, it's psychological. Stocks reward patience. Options reward precision. Stocks build wealth quietly. Options create moments of extreme gain and extreme loss. Understanding both gives you an edge that most investors never develop. And that edge, over a lifetime, is worth more than any single trade. If you learned something new today, smash that like button. It genuinely helps more people find this video. Drop a comment below. Tell me, are you a stocks person or an options person? I read every single comment, and I'll pin the best ones. And if you want a deep dive on option strategies specifically, let me know in the comments, and I'll make it my next video. Subscribe if you haven't already. I break down finance, psychology, and human nature every single week. I'll see you in the next one. Stocks are the foundation. Options are the accelerant. One builds your future slowly. The other can either fast-track it or burn it to the ground. The choice isn't which is better. The choice is which one you're ready for. Choose wisely.